So in this video, we are going to talk about what are the overall basics of stock market and also how does the stock market actually work. Hello everyone, my name is Nikhil and welcome to the very first lecture of the stock market investing course. In this course, we have only one simple objective, to actually help you understand how to do trading. So we will be covering intraday trading, swing trading, or if you're someone who's looking to invest in the stock market on a long-term basis, we will be covering that as well. The entire course will be broken down into multiple small videos so that you do not get overloaded with a lot of information at one time. And we will be covering important topics such as how to read patterns or how to look at charts, how to analyze charts, how to pick stocks for investing. So if you're someone who's looking forward to this stock market investing course, make sure you like this video, make sure you subscribe as well. The entire course will be kept in form of a playlist and I will be adding all the episodes in the I button on the top right corner. So without any further ado, let's get on with the video. Now starting with the basics, we all know stock market is a place where we are buying stocks of different companies. Now let's understand the entire process in terms of how does the stock market actually work. Now you can see this diagram over here. In the middle you have the stock market exchange. Top you have the publicly listed company. Bottom you have the investors. On the left side you have something called SEBI. Now you might be wondering, why do companies actually sell their stocks on the stock exchange? Now let me actually explain that to you by giving you an example. Now let's say that you are currently running a clothing business. You have one shop and that shop is doing really good. It is making good profits. Now you want to expand and for that you need money. Now what you do is that to open another shop, you can either go to a bank, take a loan from them and start a shop. Or another option is that you can approach a friend of yours, ask your friend to invest his money into your business. Let's say that the new shop requires about $100,000 to start. You have $50,000. Your friend has $50,000. Now you both put $50,000 each into the business and you both become 50% owners in this particular business. So in this case, your company is currently a private company. Now why is it a private company? The reason being that not that anyone can invest into your business. If they want to invest into your business, they need to take your approval. Now let's say that your company starts doing really well. It becomes a big organization. You have multiple different shops now. Now you want to expand even more. Now again, you can take a big loan from the bank, or what you can do is you can decide that you want to list your company public. Now what this means is that anyone in the stock market can actually buy stocks of your company and become a small investor in your business. So a public company is a company that is tradable on the exchange. So companies like Google, Reliance, Facebook, Apple, Maruti, Nestle, all these companies used to be a private company once upon a time and today they are a public company. Now, it's not that any company can go and become a public company. It's not that simple. There are certain rules and regulations for it. And these rules are listed by the government of India. And they're monitored and regulated by SEBI, which is the Security and Exchange Board of India. So only once these rules and guidelines are been approved, only then your company will be able to sell their stocks on the exchange. And when you start selling your stocks on the exchange, this is what we call IPO, which is your initial public offering. That means it is the first time that you're offering your stocks to the public. Now we have understood what is a SEBI, which is the Security and Exchange Board of India, and we've also understood the publicly listed companies. Now moving down to investors. Now once these publicly listed companies, they put their shares into the stock market, what's next? They need people to invest their money into this. And these people who are investing their money into the stock market, they are called the investors. So me and you, we are retail investors because we are small investors who trade at home. Similarly, there are institutional investors, which are firms like banks, hedge funds, pension funds, etc. So these are large firms. So when these investors invest their money into the stock market and they buy shares of a company, they become a small owner in that particular company's business. They become a small owner or they become a small investor in that particular company. Now you might be wondering, why do so many people actually invest their money into the stock market? Simply to make money. Purely because when the company is doing well, automatically the price of the stock of that particular company will automatically go up. And when the price goes up, who benefits? Definitely the investors. Investors will start benefiting from this, and this being the reason why so many investors put their money or so many people put their money into the stock market. Now you as an investor has decided that you want to invest into any particular company. Now what happens next? It's not necessary that you know the owner of that particular company. Now let's say that you want to invest in Reliance. You might not know the owner of Reliance. So how will you do this? You need to have a broker. So broker is a middleman. It's like when you're buying a real estate. what happens? You have a real estate agent. That particular agent is the one who deals with you and the owner. Similarly, in case of the stock market also, you have a broker. In India, the most popular brokers are your Zerodha and Upstocks. You can also use your banks as your broker. Now, I personally use Zerodha, so I have added the links to Zerodha in the description below. Now, what this broker will do is they will open a trading account and a demat account for you. So a trading account is where you can actually buy and sell these stocks, and a demat account is where these stocks will be stored in a digital format. So your demat account stands for your dematerialized account. That means you are able to store these stocks in a digital format. And this is why understanding how to invest in the stock market is very important, because there are tons of companies out there. If you actually invest in a wrong company and the company is actually making losses, then you will also make losses because you are investing into someone's business which is already making loss. Imagine doing that in real life. Will you give money to someone when they are actually making losses? Most likely you will not. So similarly, in case of stock market also, you need to be very careful. And that being the reason, if you haven't subscribed yet for watching the entire stock market course, make sure you subscribe. Now that we have understood how does the stock market actually work, let us try and understand why does the stock prices keep fluctuating. Sometimes you will see the stock price going up, sometimes you will see the stock price going down. Why does that happen? This is mainly because of demand and supply. When the demand goes up, you will automatically see the stock price going up. When the demand starts going down, you will automatically see the stock price also going down. Now, question being then, why at times the demand is high and sometimes the demand is less? Two main reasons for this. First, the company news, and second, because of market sentiments. Now let me explain you the first reason, which is the company news. Let's say your clothing business. Now your business is doing really well. It is making good profits. You have opened a lot of shops right now. Now a lot of people got to know that your company is doing very well. So they want to invest their money into your particular business. Now let's say you have a total of 10,000 shares. So this 10,000 shares is your outstanding shares, which means these are the total number of shares which is issued by your company. Now let's say out of these 10,000 shares, 6,000 shares are currently available in the exchange for trading. So if an investor wants to invest into your business, the maximum number of shares that they can buy is 6,000 shares. And these 6,000 shares, which is available in the exchange, is known as floating shares. So the remaining 4,000 shares might be locked by investors, or might be locked by institutional investors, or maybe by the owner itself. So that means that the 4,000 shares are not available in the exchange and no one can buy them. The maximum is only 6,000. So now, let's say there are 6,000 shares available and there are a total of 1 lakh people who want to invest into these stocks. Now automatically you'll see the demand is very high. There are 1 lakh people who want it. At the same time, there are only 6,000 stocks available. So supply is quite limited. So when the demand is high, supply is quite limited, you will automatically see the stock price going up. Similarly, let's take the other way around. Let's say that your clothing business is doing very bad and you're not making a good amount of profits. There is also news that you might shut down your company. So in this particular case, what happens? Now there's 6,000 shares in the market, but the demand is very less. No one wants to buy this stock because people know the company is not making good profit. The company might shut down in the upcoming year. So automatically, because the demand is quite less and there are 6,000 stocks available, you will see the price of the stock going down. Now, second reason, like we mentioned before, can be market sentiments. Now, market sentiment means the emotions of people. Now, let me give you an example. Let's say that your clothing company is doing very well and it is making a good amount of profit. So, a lot of people have invested into your particular business. But now, a news comes out that Reliance is planning of opening a clothing shop, and they're planning of opening clothing shop in multiple different areas within India, in every different city. Now, automatically, what will happen? People who have invested in your company will start panicking because a small clothing business like yours cannot compete with something like a Reliance. Reliance is huge, so you cannot compete with it. So people will start panicking, and what will happen? When people panic, they will start selling the stocks of this particular company. Now, when they are selling the stocks of your company, the demand for your stocks will start going down, and automatically you will see a drop in the prices. Now, let me give you another example. Let's say a news comes out that your clothing company is planning of doing business now with Amazon, and you both are planning to open multiple different clothing shops in different sectors or different cities in India, and you have already tied up with land and everything. Now this is a big news. Amazon is even a big company as well. People know that. So automatically more and more people would want to invest into your business. and that being the reason more people would want to invest and they want to buy your shares. So your demand will start going up, and when the demand goes up, automatically the price of the stock will also go up. So in summary, there are two reasons why a stock price can fluctuate. One is because of the company news, and other is because of the market sentiment. So whenever there's more demand for a company's stock, automatically you will see the price of stock going up. And whenever there's a lesser demand for a company's stock, automatically you will see the price of stock going down. So I hope you got an overall idea in terms of how does the stock market actually work and what is the overall basics of the stock market. Now in the next lecture, we will be covering two main stock exchanges, which is a Nifty and Sensex. So make sure you check out that particular video, and if you found this video useful, do like it, do subscribe, and I'll see you all in the next video.